Hey everyone, welcome to yet another episode of Punch Card Investing. As you can see, we are short 40% of our members as Frank and Tom from Down Under are out today. They will be back next week, all things going well. So don't worry, they have not left us on this Punch Card Investing train, but it will just be the three of us today, which should make for perhaps a different style of conversation than maybe we would normally have with the five people. And we're definitely happy to answer your guys' questions along the way, as always. And before we get into our conversation today about inflation to start with, we want to just remind everyone to check out the Discord in the description below. Subscribe to the channel if you have not already, and smash that like button as always if you get any sort of value out of this conversation that we have here today. And also, if you have any questions for us, again, be sure to get those going in the chat so that by the time we get to those, we'll have a nice log of questions to get to. But anyways, our topic for today, we were trying to figure out what to do. There's a lot of good trending topics right now, but we decided rather than diving into 13Fs quite yet, since we're getting into that part of the year again, we wanted to talk about inflation and how to actually manage an inflationary environment. How do you invest during inflation, stagflation like we had in the 70s in the US in particular, where unemployment might be low, growth might be low, but inflation is very high. We've got the news recently that US inflation on the CPI was over 4%, which is higher than it's been in many, many years. So obviously that is a big concern for many people right now, investors included. So we wanted to kind of go over what investors have done in the past during inflationary periods and how they've succeeded. So anyone want to kick it off for this one?
I'm happy to.
Go for it, Brad.
So I decided to look at Benjamin Graham's approach to inflation. We have here The Intelligent Investor. Buffett calls it by far the best book on investing ever written. So a lot of acclaim there. So there's a couple sections in here where Benjamin Graham talks about how to invest in an inflationary environment. So I'm just going to pull a few clips out of here. So the first part he touches on this, he's talking about, the balance between bonds and stocks in a portfolio. And he says, we added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. So, making the case there that stocks generally, can be a decent way to address inflation. We'll get a little bit more into that in a later section here. So this section is on alternatives to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935, luckily for them. In the past 35 years, the price of gold in the open market has advanced from 35 per ounce to 48 in early 1972. That's a rise of 35% over 35 years. Okay, that's what gold did during that period. But during all this time, the holder of gold has received no income return on his capital, and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in the general price level. The near complete failure of gold to protect against a loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Okay, so that's that section. So how do we hedge? All right, there's a little section on hedging against inflation. What then can the intelligent investor do to guard against inflation? The standard answer is buy stocks. But as common answers so often are, it is not entirely true. There's a figure that shows the relationship between inflation and stock prices. In years when the prices of consumer goods and services fell, right, so deflation, stock returns were terrible, with the market losing up to 43% of its value. When inflation shot above 6%, Stocks also stank, in the words of Graham. The stock market lost money in 8 of the 14 years in which inflation exceeded 6%. The average return for those 14 years was a measly 2.6%. While mild inflation allows companies to pass the increased costs of their own raw materials onto consumers, high inflation wreaks havoc, forcing customers to slash their purchases and depressing activity throughout the economy. So it talks about 2 inflation fighters that have become widely available to investors. REITs are mentioned, and TIPS, Treasury Inflation Protected Securities. So while a REIT fund is unlikely to be a foolproof inflation fighter, in the long run, it should give you some defense against the erosion of purchasing power without hampering your overall returns. So those are some sections from Benjamin Graham on inflation.
One thing I will say about TIPS, just because you just mentioned it,
Yeah.
They follow. So what TIPS are, for those of you who don't know, it's an inflation protected bond. So the the yield will actually follow inflation, and the inflation measurement obviously matters a lot there. How is the actual TIPS measurement completed?
Right.
And usually it's the CPI or something like that. So if you believe that the CPI is under reporting actual inflation, then you're getting a raw deal in that sense. So keep that in mind if you're looking at TIPS. They're not necessarily foolproof because of that. Assuming you don't trust the CPI as being fully accurate to what the actual rate of inflation is, which there's plenty of debate on how inflation should actually be measured, especially since I think during Graham's time, the CPI was measured in a radically different way than it is now. Especially after I believe the 80s is when they started bringing in all these like hedonic measurements and started tinkering a lot with the inflation rate and how it's actually measured. That is like the Federal Reserve and bigwigs in government. That's what I will say about TIPS.
Yeah, there's actually a website, I think it's called Shadow Stats, and it aims to more accurately measure inflation using commonly available prices for things that a lot of people buy. So check that out if you're interested in maybe getting a more well-rounded estimate of inflation.
Because I mean, the CPI doesn't include like housing, healthcare, like super
the major expenses,
like
right? Major
energy,
expenses.
like which is like that's 60% of the average American's budget right there.
Mm-hmm.
That's just not included in the basket of goods measured in the CPI. So you got to take that with a grain of salt, like Brad's saying as well.
The Fed said that the inflation is just a transition, right? It's just
and then they say it's transitory, so they won't count certain things. But like, isn't all inflation inherently transitory? It's not. Nothing's permanent. so it's just there's a lot of manipulation there is what we're trying to say. So just be careful where you're getting your data and always challenge it. Also, Brad, when did you say the gold price measurements were from? Like he's measuring the return of gold from what year?
35 to 72 or something.
Because that was a very different time for gold as well. I will say, because it was pegged based on what the government said it was. It was statutorily defined.
It was money at that point.
Yeah, because the dollar, the U.S. dollar, could be redeemed for gold theoretically. Still up all the way up into 71 technically, at least that's how it was supposed to be. So the government actually set the price of gold, and I believe FDR.
I think you froze, Jack. I don't know if you can hear me.
Yeah, he's frozen.
Well, you're back.
Yeah, that was weird. Everything good though?
Yeah, I can hear you now.
Good.
Where did I cut off? I was saying that the price of gold, FDR raised it in 1935 up to $35 an ounce, and it was then re-raised in the 70s, I believe, up to that price. It was raised a couple times until the 70s. That was the last time it was statutorily raised. Then it became an open market for gold because the U.S. dollar wasn't backed by gold anymore, so it just kind of became a normal market.
So that's when the price started really rising for gold, because after the Gold Confiscation Act.
Right. Yeah. Because it became a market. It wasn't this weird kind of top-down thing, and also there was such imbalance with the amount of money that was being printed versus the amount of gold that we had in reserves as well. So gold market back then was definitely different than it is now, I will say.
Yeah.
So tips, gold, and then REITs. Real estate does follow inflation very closely, or at least it has historically. Follows interest rates a lot more now than perhaps before. But that would make sense. So
I think that, yeah.
Go ahead, Karan.
Yeah, one of the largest factors that have come about because of everything, because of the excessive money printing, has been that a lot of companies aren't distressed anymore. So even though there is inflation, companies are still kind of trotting along, even if they're not very competitive, they're still able to survive. So like a low amount of inflation, I think should be fine, should be manageable with the way the companies are growing earnings and everything.
Yeah, low inflation shouldn't be a particular problem. Yeah. Where inflation really becomes a huge problem, and it's very rare, is when you get into like hyperinflation territory, especially. That's usually coincides with some sort of societal like hazard or chaos. That's when it gets really bad. But I think what perhaps we have to more likely watch out for is something like stagflation, where you get high inflation for maybe a number of years, not societally collapsing inflation, but significant inflation where your cost of living is rising maybe 10% a year or something like that, to where you got to have investments that can keep up with that. Otherwise, you're going to lose so much purchasing power if you don't play your cards right.
So I just looked up gold real quick. From 1972 to 2020, the compound annual growth rate was 7.9%. So basically 8%. So yeah, it is much stronger in that period.
And many would argue that that's more accurate, more indicative of what the actual inflation rate is, about 7% a year. People would argue that. Granted, that's only one thing to look at. Gold is more useful, I think, for that measurement than, say, like a copper. That's like an industrial metal. That actually has more fundamental use in things. So there's different demand pull factors there. Since gold doesn't really do anything other than you use it for jewelry, I suppose. It's the intrinsic value, and I think it's used in some tech components, but very limited. So yeah, gold is often used as the closest physical metal substitute to money in a lot of kind of monetary theory guys' perspective, but it's flawed. There's no perfect comparison to cash.
Right. Cool. So which two did you guys have in terms of super investors, how to deal with inflation?
So I looked at Howard Marks, who talked a lot about distressed debt. And that's what he kind of said, like there's no distress in the market. So they've had to go about and look in other parts of the world, more so in Asia or Europe, to get those sort of deals that they normally do get. He also talked about how the US should borrow for a longer term. So, Jack, I don't know if you can find what Argentina did. So they had like 100-year bond that they issued recently.
Right.
I think you could probably pull that up. So yeah, his opinion is that the US should be borrowing for 100 years. Like at these rates, it makes a lot of sense to borrow as much and then,
but who would buy it?
Do its thing.
Who would buy it?
People are buying Argentina's debt for 100 years. So
are people buying it or central banks buying it?
Well, someone's buying it.
And that's usually the central bank. I mean, that's what's happening in the U.S. We have super low rates, obviously, but no one's buying it. Stan Druckenmiller just came on to CNBC recently and gave his prediction, as many bears have been saying, that the U.S. will lose its global reserve currency status because of all these inflation concerns, how we've been blowing out the spending across the board. But he mentioned a couple of very important stats. Last year, there was actually a massive $1 trillion outflow from foreigners in dumping their U.S. treasuries, yet yields stayed really low. And that's because the Fed has been buying all these treasuries. So the Fed is the one who's actually buying all of the new debt. No, foreign investors, whereas maybe in the past were buying it, they're not buying it now, which means that the debt's being monetized, which means more money's flooding the market to buy this debt and to keep yields low. Because I think if we had a real market with treasuries and they were actually had to be bought by investors, not some central bank that can print money, yields would be dramatically higher because people are expecting more debt spending in the future. So you're not going to take you're factoring in inflation into your real price. But I think the yields that we're seeing now across the board are not legitimate. Well, I mean they're legitimate in as far as they're not fake, but it's because of what central banks are doing, not because of what like a true market is doing on its own. That's my hot take on it. I don't know if you guys have thoughts on actual like where yields come from.
I mean, there's always going to be a demand for dollars because around the world, people are investing in the American market. So, me living here outside the US, I'm still like, using my local currency to purchase dollars and then invest in the American markets. So, overall, from not only is it demand from the global central banks, but there are also retail investors from all over buying into the American markets and buying dollars essentially. So,
And that's what David's saying here. Drunken Miller also mentioned that, called it more of a swap in that they were dumping treasuries because why would you want to hold them making nothing when the Fed will just buy them for you? And people were instead putting it into growth stocks and many of the U.S. equities, for example. You saw huge inflows there. So yes, they were still in dollars. Now the question is what happens after that? Do they stay in those growth stocks? Do they move into value stocks across the world? That's the question. But I don't think people are actually buying super low yielding treasuries when you have a government saying they're going to blow out spending even more in the coming months. It just doesn't make any sense.
Yeah.
But the U.S. is a long way, I think, from like losing the dollar as a reserve currency. But I mean, a few bad steps could easily make that not the case.
one of the largest consequences of the lower yields is that a lot of people who are savers, people who are older, are being forced into risky assets.
Mm-hmm.
So that's a trend that I've also noticed. Like
Definitely.
Yeah.
And that's what they're trying to do, but
Yeah.
pushing yields down there and trying to encourage risk taking.
Yeah.
I think intentionally is what it seems like that's a natural consequence of when you make the risk-free rate so low. We're really to buy a short-term treasury right now. It's more like return-free risk. So I've heard it called, and that you're buying a bond to get zero return. Like, why would you do that? There is a chance, very slim. There's a slim chance that the U.S. defaults on its debt or something like that, or you get inflation. That's a risk in itself. But you're getting no return for that. So, like, why would you do that?
But look at what the big investors are doing. Like Buffett is still holding on to like almost 150 billion cash. Sam Zell is still holding on to cash. So, and if we go by people who've actually gone through times of inflation, look at what they're doing. Yeah.
Yeah. And I was going to talk about Sam Zell, of course. And he in the 70s had a lot of cash still. So it doesn't mean that cash is worthless. It just means that there's a risk to holding cash during an inflationary period. But there's always a risk to holding cash because of that. However, even though there's that risk, you could say it's easily outweighed by opportunities you could have by having all that liquidity in a crisis, which is what Zell did in the 70s. His big moves that he made in the 70s, mainly the mid 70s, he went and bought distressed real estate because it was during stagflation. You had an actual downturn in real estate due to oversupply from lots of building in the years before. He went into those distressed assets, refinanced their debt because lenders didn't want to actually foreclose on these buildings, and said, hey, if you can make the payments during this crisis, go ahead. We'll give you a better interest rate and it'll still be fixed. So he swapped the debt essentially for this very favorable terms, and then rode the inflation wave, which ate away the value of the debt. But the lenders just simply did not want to have to default or have to foreclose on this property, so they gave him the sweetheart deal. But he wouldn't have been able to do that if he didn't have this war chest of cash to pay for that debt. But the key there was that it was fixed rate, and that the debt interest rate did not go up as general rates went up, especially in the late 70s into the 80s. So because he had that fixed rate debt, he could ride this inflation wave as the value of his properties were going up in price, but the price of his debt was staying the same. And so he got that nice delta there, which is where he made a huge return there. But it all started with him having cash. So he wasn't fully invested and leveraged out of his ears. going into the crisis, he still had plenty of cash to where he could actually take advantage of the crisis.
He's been buying gold though, hasn't he?
He said that recently. I don't know how much, but Zell said after bashing it his whole career, he finally did buy some gold recently. I don't know how much, but it's sort of akin to Buffett's very brief stint into Barrick Gold, but that was super brief, and that was a mining company as well, so it wasn't like straight gold. It shows you the nervousness about inflation, I think, among many larger investors. I mean, we're seeing inflation now. The question is how much we see in the future. Seems like it's going to be as much or more in the near future, at least, but time will tell. So but Zell clearly thinks it's worth having that hedge on by having some gold there, since he does have plenty of cash anyways. It's not as though he's emptying the war chest into gold.
Yeah.
Well, I know it's on Sam Zell's mind, this possibility of the U.S. losing the global reserve currency status.
He said it too, yeah.
Yeah, I think it was like a Real Vision talk or something. He said he could see it happening within as soon as 10 to 15 years. So,
and Drunken Miller said 15 as well.
15, yep.
It's impossible to say because,
of course,
with these longer term, it's more of a geopolitical thing, which who knows what will happen. The U.S. could be the best of a terrible bunch, so it's hard to say. Like the U.S. could be doing everything wrong, but maybe a bunch of other countries that would be the next in line would be doing even worse. So that's what makes it complicated to try and make those predictions. Same with like Dalio. We've talked about him before.
Sure.
He makes these grand kind of very macro level 100-year trends, but if he's wrong by 5%, that's 5 years in a 100-year span, So when you're trying to like make a easy prediction, it's very hard, or like an actionable prediction, there's not much you can really do.
True.
Even if he's off by 10%, that's 10 years now, if we're talking about like a 100-year sort of period. Macro stuff, it's fascinating, it's fun to study, but it's just impossible to time because it's so many things go into it and it's changing all the time.
Impossible unless you're Druckenmiller or somebody like that.
Yeah, they got it. They got that crystal ball.
No, unless like George Soros, who kind of crushed the Bank of England.
That's more like arbitrage. That's a little bit different, but he had a bit of an inside edge.
I think Buffett's advice suits us best. Buy good businesses that have pricing power. And done.
Yeah, that's what Ackman said in his recent interview too. Since he dove into Domino's recently. I mean, talk about a business with pricing power. They sell pizzas. You can change the price of a pizza very easily.
Did he not already own Domino's?
No, he did not.
No.
Oh.
He had sold off, Ackman sold off Starbucks.
Wow.
Which was probably the biggest thing. That was the one that seemed the most overvalued just based on its price right now, in my view. So I'm happy he sold it as a Pershing Square shareholder.
Yeah.
And then he circled that into Domino's recently, which he just revealed on Wednesday.
Starbucks was his biggest investment. So after he unwound the credit default swap hedge that he had in place in March, he put in around 600 million into Starbucks. And that investment kind of grew to over $1 billion. So he did pretty well
in like less than a year.
Yeah. And I don't think he sold that off because the stock went up too quickly. I think he's kind of building up cash for the Spac. That's my opinion. Yeah.
Like he wants to buy more into the Spac or buy more warrants or something like that?
So the Spac has a total value of around 5 billion right now, but Pershing has an additional 2 billion in forward purchase agreements that they can buy. So he can increase his size on the deal, as in for Pershing Square shareholders in the deal. So I think he's probably looking at that, increasing the allocation. And
that would make sense because how many billions? So you said it was up to about $1 billion in Starbucks was the full position?
That was the realized and unrealized value, I think. But it's a little bit more because that was when the investor presentation came out. So
sure,
it's already gone up more since then.
We'll see the actual amount. In 6% of Domino's is, what would that be? That would be like, because it's a $16 billion company, I think. So I think that'd be kind of close, or it'd be a little bit less. So maybe, it's like here. What?
But
what
he
is
bought it at a price, I think, of around.
Bought it around 330, right? I forgot about that.
Yeah, he bought it right when it dipped, so it felt like 330 for like
he nailed the bottom.
a few days. Yeah.
Here, I'll pull up the chart in a second right here.
I'm assuming he can't add to the SPAC before there's a deal. Is that right? Does it have to be after the deal?
I mean, it exists, so he can buy into it anytime after the deal. Yeah.
Yeah.
Up to 2 billion. So the total value of Pershing's investment can be around 7 billion.
Okay.
So 4 billion from the SPAC plus 1 billion from Pershing Square right now, plus an additional 3 billion.
Gotcha.
In forward purchase. Yeah.
Okay.
All right, here is Domino's. And
16.6, it looks like, Luis.
he bought. He said he bought around 330, and they didn't get to buy for very long because it popped after that.
Yeah.
This is over a span of a couple weeks, and now it's up to about. He's already up almost a quarter, or I should say a third, almost up a third on. If he bought most of it at 330, it's hard to say what he actually bought it at. What was that, Karan?
Is that the stock price or is that the market cap?
Market cap.
Yeah, market cap is about 16.6 billion, and then the stock price is about almost 430 now. I got it on the screen.
No, but he bought it at 330, right? So
yeah, he said he started buying at 3. He said he started at 330. So
12 to 13 billion is the market cap that he probably bought it at.
Yeah, and he bought 6%. Well, he says and he says they own about 6% now. He said that as of Wednesday. So I don't know if that was 6% then, and then it's.
I think that was it. Like he just said he bought it, and then when the price went up, he kind of stopped buying.
Yeah, he said they wanted to buy more actually, but didn't have the chance to.
So I think 6% at like what 12, 13 billion. So he probably put in like 750 million in there,
which would leave a little bit left over, like you're suggesting. Yeah, I think that could totally be the case.
We'd have like 400 to 500 million more, just from the Starbucks position.
Karan, I wanted to ask you, with Howard Marks, I'm assuming we can't see what distressed debt is being bought. That's not something that's required to be disclosed. Is that accurate?
Yeah, I don't think we can actually go and dig into oak trees.
Right.
Yeah.
Unless he's buying like ETFs or like stock funds of bonds.
Right.
I highly doubt.
Yeah.
David says he stole Domino's Pizza.
He's very good with food companies like
this. Yeah, he's got restaurant brands. He's got Chipotle, had Starbucks. Now he's got it's like it always seems to be like a third of the portfolio at least is restaurant or food companies.
Circle of competence.
I don't think he really enjoys the product himself. I don't know if he does.
Oh no. Oh no. He's definitely a posh New York restaurant kind of guy, not a Domino's Pizza kind of guy. I'd be shocked. Maybe he'll be more of one now. I don't know.
So I'm just looking through these comments. Luis asks, Seritage is a REIT, right? It absolutely is a real estate investment trust. Yes.
Seritage is more like a company that resurrects zombie properties more than a REIT.
At the moment, yeah.
Yeah.
It's more of a flip company at this point, Yeah. They do property flips for the most part. At their current state. They're hoping not to be that over the long term.
Yeah, if they can make it in the next 3 years, say by 2023, 2024, they will be good.
If they can stick the landing for sure, yeah.
Yeah.
There's
or just not crash and burn, not even if they stick the landing.
That's a substantial risk right now in my view. But if they can stick the landing even mostly, they'll be in a great place. But that's a risk you're taking, is that they don't, and that seems to be built into the price depending on how you value it. Certainly a lot of bigger players think so. After Dinner Investor says, inflation fears are a good reminder to always focus on the business. That's what we like to preach here. Maybe we should add, will a high inflation environment help or hurt this business to the checklist? I think that's something that I'm considering. And I don't know about most businesses, but many businesses do have pricing power built in. It's those businesses that maybe have long-term contracts where they can't change the price, or otherwise just don't have that pricing power. I can't really think of many other situations where that wouldn't be the case. In some other cases, like a mining company comes to mind. Not saying you should go invest in mining companies, but something that has a lot of capital invested up front. That's almost like a leveraged play on whatever the actual product is. You can say the same about maybe like factory equipment or something like that. The value of all that stuff goes up too, as they're trying to produce whatever good or service it is. And then, of course, any company that has a bunch of debt that could be wiped away, fixed rate debt specifically, by inflation, they could be a beneficiary too.
Yeah, I was also from last week. Tom was talking about showing the pricing power of See's Candy, and I thought about if people are buying See's with like Visa or MasterCard or American Express, right? Those companies are benefiting from that same pricing power that these consumer goods companies have. So, Guy Spear, I think, talked about that as well. How great it is to own these credit card companies.
Yeah, because as spending is rising, maybe just in nominal terms, but that means their fees are rising, transaction fees, interest,
exactly,
and variable rate interest at that, so they can bump that up too. So they're in a pretty good position. You wouldn't really think of it at first, but that could be definitely a good area to focus on. Not saying there's any good deals at the moment, but could be.
There's a lot to payment processing, and the space is getting disrupted quite a bit.
Yeah.
New players like Square and Stripe. Stripe isn't public yet, but who knows?
Maybe Ekman will take that one public.
I think he passed on Stripe, or they just were not ready to go public. I think he mentioned that. But
I remember I heard about Stripe a while back with that, but the speculation around where the Pershing Square Spac, Pershing Square Tontine Holdings, speculation right now is Bloomberg, which that would be an interesting one. And what are the ones have you heard, Karan, that are kind of the leading ladies for this?
Bloomberg was the only one that seemed plausible. Like I thought that could work out. Honestly, I'm just like, okay, whatever it is, we're going to be benefiting quite a bit from it. I'm not really worried about which company it is.
Because of the warrants. You can't get it at a terrible price, though.
Karan's like, just do a deal. Just do a deal.
Yeah,
really,
do a deal.
If he does just do a deal, they should cash out pretty handsomely. Pershing Square Holdings, that is, because of those warrants. It's like, I don't want to say it's free money because it's a lot of work to actually do a merger, but it's some substantial upside if they can get a decent deal. Yeah. Not even a great deal, but a decent deal.
And the upside is more so for us because we're in Pershing Square Holdings, not Pershing Square Tontine Holdings. Yeah,
I'm in both. I have a little bit in Tontine Holdings, but substantially more in Pershing Square Holdings.
Yeah. What price did you get in at
for Tontine Holdings? I'm around. I think my average cost is like just under 24. So it's like right at that warrant price. So I'm not really getting an extra benefit, but I invested in that like long ago, and I got as high as like up 40%, and it's come all the way back down almost to my cost.
25, I think, is where it's at now.
Yeah, so it's up a little bit now because of that recent interview where he said they're potentially close to a deal.
Pump.
Yeah, a little pump
he
action.
Mentioned that the deal's going to happen in Q1 2021.
Mm-hmm.
So I think that's why people had options in place.
Yeah,
and that's why the stock went up so much. Yeah,
it went up like crazy. I was like, I should probably sell here. This is kind of nuts. Like a cash vehicle is up 40%. Like, like okay, but nope.
Brad, are you still in it? Oh,
no, I got out with a little bit of a gain and did something else with it.
Nice.
So Bugalugs, New Zealand. We've got a New Zealander in the house, even though Tom couldn't make it. What time of day is it where you are? What time of day is it for you guys? So it's 8 p.m. for me. Jack, I think it's 10 p.m.
10 p.m. here in Chicago.
Karan, are you 8 a.m.? Is that right?
No, he's like 7
a.m.
Yeah. Karan gets up bright and early for this.
Yep.
And then New Zealand time, what is it, like noonish? Something like that. Just about midday, if I'm not mistaken.
Yeah.
So
can't speak to that.
We got our 5 time zones we normally have to juggle here, so this is kind of our window. 3 p.m. in New Zealand, so excuse me. Is it yeah, anyways.
It's morning, afternoon, and night.
Yeah. We have all time zones covered. Here's a question from
Yep.
Coleman here. Why do you think Ackman owns Lowe's over a company like Home Depot? Because it's a smaller company, so he's able to make more changes, perhaps? Or do you see something that makes Lowe's better? Do you know when he got into Lowe's, Karan?
I don't know the exact date, no. But I know he's very happy with the CEO. He mentioned that in the recent interview.
He's
of
big
how
on
the CEO
teams. Yeah.
Yeah, of how the CEO was able to incorporate new changes and kind of upgrade the entire infrastructure of the company. So I think he sees management as a key factor in his investment, and he probably saw a better management with Lowe's as opposed to Home Depot. So that might have something to do with it.
Looks like 2018 is when he started. Yeah, spring of 2018. So let's see, what was the price then? It's kind of
He
hard to
also
say.
mentioned that he sees Lowe's more of as a bond sort of in the portfolio, like a bond equivalent. So something that's stable, pays out a dividend.
That's a
kind of how he
favorite
sees
term
it.
among investors right now. Just calling a stock cash or a bond equivalent, because bonds are just so bleh right now. It's like anything that produces stable cash flows is automatically a bond in this crazy environment. And I kind of doubt he would. I think he's been pretty kind to Home Depot. He says like it's a very similar business, if I'm not mistaken. So I'm sure if he was given a chance again, unless there was something he saw that he didn't like with the Home Depot team, then I don't think he'd really mind being in either, since there's such similar businesses. I do think it's the team, to what Karan's saying, that's kind of Ackman's big. It seems to be his number one sort of concern going into investment. He has others, of course, looking for stable cash flows, predictable business, yada yada, all that great stuff. But having a great team, or a team that he could make great, that's kind of his big sort of niche in investing that he seems to follow pretty closely.
It doesn't always work out, but
Nope, doesn't.
like JC Penney was a huge example of things not working out. But
that was kind of a high risk, high reward sort of play. It's a massive retailer. He obviously thought it was lower risk than perhaps it was. And they tried making big changes and they just didn't work. But he put in a really high quality CEO who he says got over aggressive on things, just didn't work out as it could have. But the good thing is, Karan and I have talked about this before, but he's learned from those mistakes. He's very candid about what he's learned there and what not to do in the future when implementing large scale changes, especially on a large business like JCPenney. So in that activist sort of space, it's great to have some experience with failures too, as long as you can put those failures behind you and keep moving forward.
Yeah, what's happening with those JCPenney properties? We gotta maybe get our hands on those, or
Yeah, that's a good question. I haven't heard anything recently.
Seritage, snap them up.
Yeah, there's been a lot of news with Simon Properties with they had their big lawsuit like with Gap, and a lot of the kind of the big theme of retail mall real estate over the last year was lawsuits between the big box tenants and their mall landlords. Simon Property being a massive mall landlord, and Seritage being in not as good of a spot as Simon Property. Simon Property is kind of that Class A mall REIT, whereas Seritage is trying to convert old large retail spaces into other things. Right. So different sides of the same coin, I suppose. But there was just so much turmoil in retail over this last year. It'll be curious. I'm curious to see where Simon Property goes with now that things are starting to open up again, and how much mall traffic's going to come back, since they really need it because they got a lot of debt too. And I'm also curious to see if Seritage can pull off their transition with many of these properties in time and without being destroyed by increasing material costs, as we've been seeing across the board, things like lumber and all that. Speaking of inflation.
Yeah. So here's one related to Howard Marks. Luis asked, wasn't Oaktree Capital absorbed by Brookfield? Yeah, I did hear that. Do you know any details about that, Karan? I know Brookfield is one I've seen a couple times recently turning up in corner of Berkshire and Fairfax that, investors are getting excited about. But what do you guys, what's your take on that?
They've been doing a lot of deals. Like I think Brookfield Properties was absorbed by Brookfield Asset Management. And
It was.
I think they also bought like a majority share in Oaktree. I think 60% share or something. 60,
I got
60.
the news here. September 30th, 2019. Brookfield Asset Management completes acquisition of 61.2% of Oaktree. So yes, they got most of it now.
They're just absorbing. And Brookfield Asset Management was one of the spawners also, right? In Pabrai's list of...
I didn't notice that one.
I'm pretty sure it was there. Yeah.
Okay.
But they did, I guess they did absorb Oaktree, for Luis's question.
Here's one for you, Brad. We were talking about it before the show a little bit.
Of course.
Big news. We knew it was going to come up. Big news. Monish Pabrai, shameless cloner, following Charlie Munger into Alibaba. What's your hot take, Brad?
Yeah, it was revealed today. Monish Pabrai did buy in. I think it was, it's his 5th largest holding. He's got like 8 or something like that. 38 million, I think it was, on the books as of the end of the quarter. So, to me, this is obviously it's a spawner. Pabrai has talked about Alibaba as a spawner in some of his presentations. I wasn't convinced that Pabrai was going to follow Munger into it just because it's so big. And Pabrai has said he's looking for small spawners, right? Sub 500 million market cap. And Alibaba is like 600 billion or something like that. So I was a little bit surprised. But, on the other hand, who does Pabrai have behind him in his office in the statue, right? Munger. So Munger is just like, the tops for Pabrai. So, I think it was largely a shameless cloner bet on Pabrai's part, but fun to see. It was fun to see.
He could easily kind of be like, "Oh, it didn't work out." I mean, I followed Charlie Munger. Like, sorry.
I don't think he's ever going to throw Munger under the bus like that.
No.
But yeah,
we'll see.
Yeah.
How much is he managing totally? Like 500 million? Is it?
Yeah, I think it's a little over that, maybe 600, somewhere in that ballpark at the moment.
So 38 million, is it really a significant holding?
I figured it was like a 7% bet, something like that.
Pabrai funds as of April 12th, it says it's grown to over 400 million.
Okay.
So, but that is from April, and I don't know if anything's happened since then.
This is from which source, Jack?
Guru Focus. So, it's probably aggregating it from somewhere else.
Well, we could probably aggregate it quick from Ticker, right? Would that be more accurate?
Probably, yeah.
Yeah, but he's also been raising capital, right, recently, over the past 6 months or so.
Did he open the fund again?
Yeah, it was there in the...
That could make a big difference then.
Yeah.
So, yeah. Yeah, it's unfortunate. It doesn't show like total in Ticker, which is kind of annoying.
Yeah, so you got to edit yourself. Here, I'll do that real quick.
But yeah, if you look in Ticker, you can see it's somewhere around. There it is. It's already updated in their 5th largest holding. So
I'm really surprised by it. Like, I did not expect this at all.
I know you didn't.
It's around, according to Ticker, if we're going off of this, which it's around 480 million. So we'll just say 500 million is around what he's managing. So.
Okay, then it is kind of a noticeable position in the portfolio. It's not a tiny position, yeah.
No, it's not.
Nope.
So yeah, that happened. It was a lot of activity on Twitter about that today.
You got another video coming out soon about it, Brad?
I'll probably mention it tonight. I'm going to make a video after we're done. So
tune in to Brad's channel in a few hours.
Thanks for that plug, Jack.
Yeah, I had to. Let's see here. Back to SRG. How much could inflation adversely affect SRG given that they're restructuring their assets and they're already short of cash? I was kind of mentioning like material costs could be a big thing if they can't raise their existing rents, for example, to make up extra revenue. Because their big anchor right now, in a bad way, is their empty properties, and unless they put in like bargain rents or something like that, but that's not going to keep up with the actual cost to keep those properties. So the problem is they got to offload those properties quickly, which if inflation rises, they can get rid of them at a higher price. But again, you're still seeing your operating costs bring you down a bit. But then the input costs to actually refit some of these properties, lumber, any sort of materials right now are all going way up in price because of supply issues, also inflation. That's a big concern in my view. I don't know how they're going to manage that, or if that's not a huge deal because they're such a huge builder, perhaps that maybe they get some sweetheart deals on some supplies, but it's affecting the whole industry right now. These material shortages and massive price spikes. You guys have any thoughts on that? And how inflation might affect SRG and their retrofitting operations?
Karan, anything from you?
With SRG, I think the main thing that's actually keeping me okay about the position is the price that we were able to enter at.
Mm-hmm.
So that margin of safety cures all. It could
Agreed.
be inflation, it could be cost of materials, whatever, right? If you've got significant margin of safety, you're good.
And there's a saying in real estate as well that you make money when you buy. It goes for stocks, it goes for everything. But if you can insulate yourself, that's always huge. Because then if you do need to sell, like you already have some space, or you have some time at least to let it go down a bit as they try to redo things or whatever. Then it can go back up once they actually get going. So, well said, Karan.
I don't know. I mean, they are getting I think around $16 per square foot right now, by the way, which is way better than the $4 or $5 that they were getting from Sears and Kmart.
Yeah,
and
but it still takes time, and there's limited buyers right now for retail type properties. That's the big thing that hurts is they can't just put them all on the market at once and expect top dollar. You're just not going to get that right now for retail. So that's why they're doing all the refitting anyways.
Yeah. With Heritage, it's all about patience. Just wait it out. It'll work out.
Yes. I mean, that's what pretty much all long-term investing. Yeah. It's patience. Patience is key. I mean, time is money. Time value of money is a thing because you have time to grow that money as years pass.
Here's opportunity cost.
Yes, sir. Here's Scotty. For Australia, UK, and Hong Kong, real estate tends to do well during periods of economic decline and produces sound value growth during periods of growth. So you're saying it does well in all markets is what it sounds like. Is this the same in the U.S. or is it less stable? The U.S. real estate market is very much tied to interest rates. It's historically prior to 2000, it followed inflation almost in lockstep. But since 2000, as debt products have expanded, especially with the Clinton era, you had a lot of home buyer programs that opened up to try and get everyone into home ownership. You saw this divergence away from inflation, and it largely follows interest rates in a very big way now, to where a 1% rise in interest rates will crash prices around 10% across the board. So it follows debt. The system is just so laden with debt in the U.S. that it's more of a debt market than a real estate market. So I don't know how that is in other countries. I think the U.S. is pretty unique in how much debt is in the system. Not that other systems don't have a bunch of debt too. It's just not nearly as much, from my understanding at least.
The countries that he's mentioned, Australia, UK, and Hong Kong, also have a huge amount of foreign direct investment from other countries.
So does the US, though.
Yeah, but I mean, Hong Kong is tiny, right?
Yeah, sure. Like
with Australia.
On a per capita basis, what you're saying, right?
Yeah, so the real estate in Hong Kong is, I think, the most expensive in the world, right? And they've covered this in Real Vision a lot. There's some investor who keeps talking about Hong Kong and China and the peg and so on and so forth.
Mm-hmm.
Yeah, real estate prices in Hong Kong might be extremely high, but there's reasons for that because people need to buy whatever price. Even with Australia, they haven't experienced a recession even in 2008. I think over the last 20 years or something, because of their resources, because of the continuous demand for their natural resources that they have. Yeah. UK is going through its own problems, so real estate is the only thing that people are interested in, I guess. Yeah. Anyway.
The one advantage real estate always has is it's first off, it's unique in that you can't, if you're in like a particular area, you can only have one property on one plot of land. You can't have others there. So you have an inherent monopoly, really, if you want to look at it that way. Sure, people can build around you, but in some way you are insulated in that is your plot of land and no one can do anything to it. Unless the government takes it from you or something, or your creditor. so that is one thing that it always has going for it. And people do need a place to live. Businesses need a place to stay. Even in an e-commerce world, data centers are a thing. Space is needed for everything. It's just how the space is used that changes. So that you always have that advantage. Not that it's always going to go up, but that's kind of what's been driving real estate forever. And it's one of the oldest industries in history, land. So, and that makes sense why it is.
Oh, I didn't realize Brookfield Asset Management is in the free lunch portfolio currently. Okay, now it rings a bell.
Ta-da!
From David Tepper. All right.
And they are also
another
invested
David
in GraphTech, I think.
Yeah, they do on GraphTech. Yeah.
David asks, where are the major properties for SRG located? The ones currently being redeveloped. We talked a good bit about this. Was it last time or 2 times ago? I think it was last time. We talked a good bit about SRG. But what were the major ones? Were Dallas and
Redmond, Chicago, even in Chicago.
And Chicago too.
Yeah.
We didn't talk about the Chicago one. Which one is that? Do you know?
I've highlighted them, but I don't have the list with me right now.
Yeah, there's one in Miami. There's one in Alexandria. In the live stream I did with Tom, I kind of highlighted 8 different properties that are considered.
I was thinking of your live stream, Brad. It was right after our episode.
Yeah.
That's right.
That they consider some of their premier properties. So take a look at that.
Another plug for Brad. Go check out his live stream he did with Tom. His update on Seritage Growth Properties. That was a really, really solid one.
Cool. Yeah, it was great to have your comments, Jack.
Oh, absolutely. that your first Seritage breakdown was that you did with Tom was where I discovered you, Brad. So
all right,
it's like full circle.
We don't know which properties are going to survive, so
nope.
Just got to shotgun it. Shotgun approach.
Yeah,
that's the advantage of having a large portfolio.
Yeah. It's the same thing with like what it was with EQC. Like, I wasn't concerned about the properties because eventually it's cash.
Yeah, like, it's going to be outweighed easily.
Yeah.
And it's already going to be with the merger. You got 120 industrial properties. It's going to squash the 4 office properties like in no time. So
with Seritage, we still have like 178. Is it, Brad?
Wholly owned, it was 154, and then there's the joint ventures as well.
Plus 25 JVs.
Yeah, that's right.
So most of the wholly owned are going to be cash. So let's just wait and watch.
Yep.
Yeah. Just Invest Today rightfully points out, Ackman said he's been working on this Spac deal for 6 months. He hasn't said what it is, but we were talking about it might be Bloomberg, something complicated, and I think Bloomberg has a complicated structure since it's a partnership. So that would make some sense. Plus, it's huge. So it's something big that they're cooking. I don't know if they're actually going to go through with it, but they're definitely it's definitely something big, and apparently they have taken 6 months, according to what Ackman said on his recent interview on this current deal. So it'd be disappointing and perhaps unexpected if it didn't actually go through, given the amount of time and money they've obviously sunk into due diligence.
How has Pershing Square done this year, 2021?
It's been pretty flat this year. Obviously, it doubled last year.
Oh, but, it ripped last year.
Since January.
In terms of the net asset value, it's different, right? It's not.
Yeah, net asset value's been going up. But the actual price of the fund has been pretty flat.
Okay. Yeah, I see that.
And
so what they're doing is they keep increasing the net asset value and then keep buying back stock. So it's great for if you're trying to buy in, if just from that perspective. Not financial advice.
Oh, definitely not. But that is a nice little. It's some nice cherry on top. get some.
Plus, they give out like dividends of like around 1.1%.
Throw people a bone. And I wonder how. I don't know how much it has to do with the fact that they're not like on like the New York Stock Exchange or something like that. I do kind of wonder. Is it like just because it's over the counter here in the U.S., so that's like a $50 transaction fee? That's going to deter some people, I'm sure.
Yep.
However, you also will eliminate a lot of like downward volatility as well, I'd imagine too. Just when you don't have as many like short-term retail traders coming in or something like that, or even like larger scale retail traders or larger scale short-term traders. So I don't know how much that affects it, but it just seems weird that
there's a reason we structured it that way, for the tax, for corporate tax.
Oh yeah, I understand why they did it, but I just wonder if that has actually like hurt them, in that their net asset value is like almost always higher than what the actual fund value is, which is kind of strange that it would happen for that long. You'd expect it to be equal, right?
But it's always the case with closed-end funds.
Is it always? But like that much?
Almost. Yeah.
Really?
It's very normal to see closed-end funds discount at like a 70-80% discount in NAV.
Yeah.
All right.
There's what are the fees? 2 and 20.
So it's 1.6 and 16.
Okay.
1.5 and 16, but yeah, it comes up to around 2 to 3% basically.
Yeah.
Yeah.
Okay, more questions. Who's got more questions? Yeah, I know, Baba. There's a little bit. No, it's not true. I'm fine that I bought a little while ago. I know it's gone down. It's okay. This is all part of the game.
That's right. You'll be okay, Brad.
I'll be okay.
Hey, I missed that Hertz pop on April Fool's Day. I said I put my whole portfolio into 2-week Hertz calls, like way out of the money, and it recently went up 200% in like 4 weeks because Hertz, of all companies, shareholders are getting apparently are going to get paid in the bankruptcy restructure, which I just don't. I haven't looked into the details how, but that was surprising. So there's lots of missed opportunities, sometimes right in front of us, that just don't seem to make sense or are just seemingly random.
Well, so in the last month, it's gone from like $2 to $6.80.
Yeah. April 1st is my birthday. I think it was $1.80, and now it's like almost $7.
Wow.
Apparently, the article I read, I haven't looked into the actual details of the restructure, but shareholders are going to get like $8 a share, which I just don't understand how. I guess creditors just were like punting, like go ahead, like because the company was deeply insolvent. They had so much debt, but creditors must be taking an L or something. Have liquidity, guys, and then you can get, even if the company's insolvent, if you can get a chance to buy it at a deep discount or something like that, if you have liquidity. Not saying to go buy Hertz by any means, but to our conversation about buying in distressed times.
When did Carl Icahn sell out?
Oh, at like 78 cents, way back in last year, and it made nothing but sense. They had so much more debt, and then gosh, it's just amazing. All right, enough about Hertz. I saw that right before this call, and I was like, "What? What did I just miss?" Anyways, Scotty, another good question. In your opinion, what is the worst way to hedge against inflation?
Spacs.
Yeah, anything that's all cash, maybe.
Did you say Chamath Spacs, Karan?
Yeah, no, of course not.
No, we have only good things to say about Chamath on this channel.
Yeah, no, definitely the companies he's bringing public, like they're fantastic. But unfortunately, the SPACs are not reflecting it. I guess.
I think the big thing that's hurting SPACs right now is regulatory risk. Because the SEC, they've dramatically slowed down just in the last month because the SEC is starting to actually like put some scrutiny on them. I think that's the bigger thing that's hurting SPACs right now. Granted, you've had some like growth stock pullback as well that's certainly hurting. But
I think the fact that they're losing money kind of has.
Oh yeah, sure.
That whole thing.
I mean that too, but like the SEC is saying that they're going to have to list the warrants as liabilities. on their balance sheet. That's going to hurt like what the actual net asset value is going to look like. So there's a lot of uncertainty right now with SPACs because of that, because they're kind of on the frontier of the regulatory environment. That's my take on what's going on. And they've all gone down. It's just like pretty much no SPAC has done well. Even ones that have identified a target have been rocky. Other ways besides SPACs that are bad ways to hedge, if we're considering that as a bad way to hedge. Anything that's variable rate.
Long-term bonds.
Oh yeah, bonds.
Fantastic, terrible way to hedge.
Yes.
Bonds, great.
If you want to lose a lot of money, just dump it into like 100-year Argentina.
Any sort of fixed rate return that's like not super high, which is most of them right now. That's because all the bond is a promise to get future cash. So you're giving someone cash now to get more cash in the future. And it can't go any higher than that unless you're trying to play like the actual yield and you're going to sell the actual bond itself. But then you're speculating at that point. You're not really investing in the bond itself. You're just hoping for a price movement.
So find a long-term fixed rate negative yield bond, and you are in good shape.
Yeah, or take out variable rate debt to buy those fixed rate yield bonds.
All right, this is going to give me nightmares. We've got to move on. We've got to move on.
Take out margin debt to buy it.
Yeah, Argentina's defaulted 8 times, by the way. And the 9th time when they issued it, people are still getting into it. So,
are people really? I don't believe that people are actually buying it.
Did you pick that up from Howard Marks in that book you've been reading, Goran?
Which book?
Richer, Wiser, Happier.
I don't know. I've just been going through a lot of Howard Marks material, so I'm not sure where I picked that up. But yeah.
We have some good stuff. I haven't seen too much of like his talks, but he definitely has some good stuff.
His recent memo is interesting. The conversation with his son, Andrew. Yeah. About tech stocks, about crypto, about all that stuff. Yeah. I guess he's a bit more open to the idea of investing in more typical growth names, more technology.
Howard, what? No, we're not going to go there. Yep, bankrupt hurts to the moon. Absolutely.
Right now it is. It's an absolute rocket ship. But now it almost makes sense. I just don't know how they're getting the buyout. But I'm getting fired up.
Yeah, let's tone it down a little bit, Jack.
Yeah.
Jesse asked about hunting for credit cards. So none of you guys know. I used to be in the credit card churning game. I did that, on the side. Have you? Okay. The best one I ever nabbed was the Chase Inc. business credit card. It was like 100,000 Chase Ultimate Rewards points.
They're doing something similar. They're doing something similar. Buddy of mine with the Chase Sapphire.
Sure.
One of the Chase Sapphire, whatever the name is, it's like a $800 credit right now just to sign up for the card. I paid for my honeymoon with American Airlines travel rewards.
Nice.
Nice.
Free flights. It's easy. Like, if you got good credit and you don't need it anytime soon, it's a great strategy.
So it wasn't a total pain to find availability or anything like that using the whole rewards. Okay.
Yeah. It was an August trip, so in the States during the vacation season, so it was not a problem at all. And it probably ended up being worth like $600 round trip. Took like a Caribbean flight, went to the Cayman Islands, and it was great. Nice. So thank you, credit card points. I've been wanting to do more.
Awesome.
I've been wanting to do more recently, but I want to really keep my credit nice and squeaky clean for when I actually do like a real estate deal.
Right.
You don't want to have recent pulls. It just doesn't look good. And so I got to be careful with that. But as soon as I like close on a property, I'll probably go and get a credit card right thereafter.
What's your score like these days, Jack?
I haven't checked recently, but it should be around 750.
Solid.
So anything over about 720, definitely over 740, you're going to get the top rates. Probably 740 nowadays.
Yeah.
Before 720, you're going to get the best rates you could possibly get.
Yeah.
As long as your income and everything's okay.
Do you guys have a similar system in UAE with credit scores? How does it work there?
We don't have credit scores as such, but I mean, you can always get your credit score, get points and everything. But with credit card points, like I use them all the time. Like I haven't purchased clothes with money for like the past 3 years now, 4 years. Yeah, it's all been points. So
You're racking up a lot of points there, or you're just not buying a lot of clothes.
both.
Combination, yeah.
That'll do it.
I mean, it's not difficult to get, a simple color T-shirt.
No, definitely not.
I like your style. Is that an alligator T-shirt right there? What is that?
Lacoste,
It is,
right?
It is. Yeah.
Perfect.
Yeah. So I just get like, whenever they have discounts, I go and buy like 10 and I'm like, I'm good for the year. Like,
Yeah, I do something similar. Black Friday. I like it's this brand called Indochino. They do like custom. It's like semi-custom suits online for like you can get like an actual custom tailored to you, pretty much. It's manufactured though in some factory in China, and you can get like a custom suit for like under $300, and they're actually really nice. I used one for my wedding as well, and it was great. So. That's once a year I do like a Black Friday sale for like shirts. They do shirts as well, and they're nice and tailored too. And that's pretty much all I
need a lot more suits.
I'll be needing more soon. I've got like 4 or 5 now, and like being in the attorney world, since I'm now officially an attorney.
Yes.
As just swore in yesterday, so that's fun.
So a couple inflation hedge questions there. Our cloud yeah, we'll do that one. How are oil stocks for inflation hedge? You guys got any opinions on that?
Depends from company to company.
Yeah, if you're going for company to company, if you're just looking at oil, the commodity, even there, it's not necessarily perfectly correlated with inflation because you get demand issues with oil and also supply issues in the short term,
which we've seen recently.
Yeah, exactly. So a lot of other things affect oil in the short term and even the medium to longer term. But yeah, I guess generally you could say oil, the commodity, will follow inflation like many other things. But if you're trying to invest in the oil company itself, you got to look at debt. You got to look at their actual assets. You got to look at what they're trying to do to innovate. Yeah, there's all sorts of things. Production. And then the price, of course.
Yeah.
Yeah.
Thank you, everyone, for the congrats. Appreciate it. Sandeep says, are cloud service companies hedged against inflation?
Pricing power. Yeah. Of course. That's why they trade at those multiples that they trade at. People see the value in it. Yeah, of course.
Yeah. What's the multiple that people are applying to the cloud component of Amazon, for example?
A lot. Because it's software. That's like the epitome of like a scalable business. Granted, you got a lot of data center infrastructure you need behind it, but once that's set up, you can scale it much easier than say trying to actually put products in people's homes. And you can change the prices on that as you need it because it's just software at that point.
Yep.
So I'd say, yeah, as long as they have pricing power.
This is a ball jar, Luis. My fancy water vessel. So
is that ball?
Oh, Luis was asking.
Pick that up at your local Ace Hardware.
Is that the same thing as the Ball Corp, the one that makes the tins?
I believe it is Ball Corp. Yep.
Yeah.
Yep.
It's been a fun. I mean, it's just a company I've looked at in the past. Fantastic. I mean, in terms of, it's a commodity, but anyway, different topic, different day. Yeah.
No, I got to get better about doing that, guys. I'm using a product. I should take a look at what's going on with the stock, right? 16% over the last 10 years. Ball Corporation. That's pretty good.
Not bad.
Yeah.
Not bad at all.
Did not come with balls. All right. So where are we at here, Jack? An hour 9?
Yeah, we'll probably wrap it up here. Any last second questions here? I'm scanning the chat for any questions we might be able to squeeze in here.
But yeah, keep an eye, guys, on those 13Fs. They're rolling in. We've probably got about half of them in over the last couple of days. So there's going to be a huge flood of them coming in on Monday. So I'm very excited for that.
But yeah, I think
Everyone's just going to buy Alibaba, I'm pretty sure.
Just buy Baba. Forget about the 13Fs.
Yeah.
It's already been figured out.
Shamelessly clone. You're good.
This is not investment advice.
Disappointed. Like, it was the first thing I saw in the morning. It was like, I wake up and, oh, Twitter, great, whale wisdom, he's bought Alibaba. And I'm like, really?
Has he fallen from grace as your guru, Karan?
Hot take. Do it. Say it.
He's thinking about it. He's thinking.
He's very different. I don't know. I think 2020 really changed him.
Different. That's very diplomatic of you.
All right, we'll leave it at that.
Okay.
Karan doesn't want to inflame.
No, I mean, Karan is going to win the lunch at some point, so you got to keep the peace here.
Be fantastic. But I think that's a totally
That's what
fair
this channel
take.
is for, right? The revenue from here goes into that. No?
Yeah. Well, we're gonna get it. We're gonna buy ourselves that lunch.
That's right.
How much did it go for last year?
Oh, was it like 10 grand? Somewhere around there, I think. It wasn't crazy.
A decent
Someone
channel
bought
could
the
definitely
dip.
do that. We could definitely do that. Come on, guys, smash that subscribe button. Get those watch hours in, and then we'll be on our way towards getting that free lunch, or not free lunch. Anyways, till next week, guys. Always a pleasure talking with you, and for everyone who's been watching, as I mentioned at the beginning of the show, go check out the Discord in the description below. Subscribe, like, all that great stuff, and we will see you next time.
All right.